thanks everybody for coming on. And I'm going to do one last thing. I'm going to stream this to Facebook. For if anybody's watching there, they can also look. But while I'm doing that, Chris, if you just want to introduce yourself a little bit, and then as soon as I finish this, we can get started.
Sure. And thanks for setting this up again, Debbie. My name is Chris, and I'm one of the founders of a company called Juno, which has been working with Debbie and Road to College for the last couple of years. In short, about 5 years ago, I had to get a bunch of student loans to pay for business school. And one of my classmates and I started an experiment to see if we could bundle together a few hundred people who needed to get loans and reach out to the banks and credit unions and ask if they would give better pricing or better terms to the group than if we went there individually. A couple of places said yes. We got very excited. And what started as just an attempt to help ourselves get some cheaper student loans turned into Juno, which now runs that same exact process for about 100,000 people each year. And so Debbie and I have had a lot of different discussions about the questions that we hear from parents and students with respect to undergraduate student loans, and thought it would be really helpful to do an AMA, or an Ask Me Anything, where we cover some of the more common topics that folks ask us about in one-on-one conversations, and open the floor for anybody to ask anything that might be on top of your mind right now.
So go ahead.
Yeah, no, this is Mike. And first of all, I'd like to thank both of you for having this. My daughter's gone to her first year last year, which we paid for out of pocket, but we realized this is not sustainable. So looking into the options, it's very confusing, and I'm an IT guy and I get confused because there's a lot of, I don't know, it seems like there's a business model here that a lot of people are making money off of, so that they adjust things accordingly and things like that. But I appreciate you guys, and Chris, it sounds very interesting what you've come up with. So I would just want to kind of understand the difference between, I don't think we're going to get much federal government money, so we're going to have to take out some private loans, whether that entails having us co-sign against our daughter's loan, or having her she has some credit, having her take out the loan, and just general thoughts around that. That's just the things that I'm kind of interested in, and maybe somebody else will have something else that they want to hear.
And Mike, did you say your daughter she's going to be a sophomore, correct?
She's a sophomore, Debbie. Yeah. She would. It's like everybody here, you send them off and you think, God, are they just going to come flying back and crying and everything? But she went off and she enjoyed it, and and she's going to continue.
Good. Okay. Well, that's a positive. Right?
It's a huge positive. Yeah.
Okay. So, we can start. That's, a good, question. So it sounds like you didn't have to take loans last year. Is that correct, Mike? Yeah,
that's correct. We just kind of just gutted it out, and we realized it's not sustainable because we're some of the stuff we had for our retirement, but we're looking to do a combination of hopefully she gets to work and pays for some of it, maybe we pay for some of it, but it looks like we're going to have to take out private loans. The whole FAFSA thing, we didn't get much government assistance on that. The school did give us some, but we're still looking at some, and that's where I'm at, trying to how do we finance this? That's pretty much where I'm at.
Okay. So just, did you take, when you say the government didn't give you, and I understand that it's really the school didn't give you financial aid, and you probably aren't eligible for any of the programs that the government is offering, but everybody, and I'm going to say this for everybody, then I'm going to pass it to Chris, you can add on. Everybody can take out, your student can take out the federal direct loans, which they should be doing. So as a sophomore, your daughter can take out $6,500 on her own.
Okay.
Are you aware of that, Mike?
There is some federal loans that are listed in the financial package. That might be part of it. But so is that, but $6,500 she can take out, or the school might say, yeah, this is the federal loan. Is that how that works? Or is it something the school wouldn't even mention?
So the school probably would mention it in the financial aid award letter after you submit something like a financial aid award application or just the general application for whatever you need.
Right.
And so they should likely mention something called a federal direct loan. And
I think they did. And some of it, yeah. And then there's two flavors of that, right? There's one with you don't have to do the interest or
Yes.
there's right.
Yes.
But yes, we have that, but I think it's 5,000 or something. So I
It
don't,
should be 6,500.
I'll write that down. I'll write that down, Debbie.
Yeah.
6,500, right? Okay.
Our
Yeah.
daughter only got 5,500 on an unsubsidized loan.
Oh, okay.
Because she's a freshman. Go ahead, Chris.
Oh, okay.
Yeah, great set of questions. So this is how the federal direct loan works. So it's in the name of the student. For a freshman year, they can borrow $5,500 using it. For sophomore year, they can borrow $6,500 using it. And for junior and senior year, they can borrow $7,500 for each year through that program. And so for whatever amount you actually need to pay for school for this upcoming academic year, you should probably start with a federal direct loan and just know that like those are the caps for how much you can get through it. If you need more than that cap, which frankly, a lot of people do, there is another federal student loan that exists to help fill the gap between what you can get through that loan program we just talked about and what you actually have to pay to the school in order to attend. And that one is called a Parent Plus loan. You'd probably also see it on your financial aid award letter. But the Parent Plus loan it's just another loan program that the government has set up where the loan is in the parent's name only. It's not in the student's name. It doesn't show up in the student's credit report, but it lets you borrow all the way up to the cost of attendance. And the cost of attendance is published on every school's financial aid website. Think of it as the sticker price. It's a number that includes tuition plus mandatory fees, plus some allowance for housing, food, and personal expenses.
Great. And then Chris, this is, and Debbie, thank you guys, because I've seen the Parent Plus and I did not understand what it was, but now I am. It's federal government will loan up to the amount of the sticker price, like Scott said, like Chris said. But basically it's basically parents taking out a big loan. Yeah. It's like a mortgage for, house or something. Yeah. So this is where the inside baseball stuff comes in, because I don't really want that. You know what I mean? My daughter can take it on herself, but this is great because I know now that's what that is. I know what it is defined as, and probably not something that I want to do, or maybe only partially do it. Do you have to take the whole thing, or can you set it?
Well, honestly, so this is where the decision point comes in. So, again, everybody who's on here, if you have to borrow, your students should be maxing out, whatever the federal direct loans are that they can take in their own name. So that's either the 5,500, 6,500, or 7,500, depending on what year they're in. After that, this is the decision, is that to decide, do you want to take a private loan for what's left, or do you want to do the Parent Plus loan? And we can talk a little bit more about pros and cons, but this is the fork in the road that you need to decide.
That's great to know, because I've been looking for that fork. Where's the decisions that have to be made? And this is one. Thank you.
Yeah, maybe one just additional piece of context around that would be, when you get to that fork in the road and you're deciding between a Parent Plus loan and a private student loan, really what you're comparing at that point is, can I get a better rate or a better offer from a private lender than I can get from this Parent Plus loan? Or you're saying, I really want to make sure that the loan is tied to both my child and myself as co-borrowers on it. And so just a little bit of background is, federal student loans, as long as you qualify, have the same exact rate, same origination fee, and whether your credit is really bad or really good. Private loans, the rate's going to depend on your actual credit. And so the better your credit is, the more likely it is that you'd be able to find an offer from a private lender that could be cheaper than that Parent Plus loan.
That's excellent information as well. That's another question that I had. I didn't quite understand that, and now I do. Thank you.
Happy to help.
So Jennifer has a question. Why should we max out the federal direct loans first before other loans?
Excellent question. So the federal direct loan has a couple of benefits that other loan programs just don't have. So first of all, it is among the cheapest rates that you can find in the market. That federal direct loan is a 5.5% fixed rate. And so if you think about the cost of the mortgage, the cost of everything else right now in the economy today, that federal direct loan actually is basically the cheapest loan that the vast majority of people will be able to get. If your child ends up working in a nonprofit setting for 10 years after school, they can have that federal direct loan forgiven. If for whatever reason they don't land the job they expected to, or if they're unemployed for some extended period of time after graduation, they can also limit how much they pay on a federal direct loan to a pretty low percentage of their discretionary income. And so just think of the federal direct loan as a program that has both low rates and a lot of protections built into it that other programs are not designed to have.
Chris, there's a really good question, and that Janet's asking about what about the New Jersey class loan? What's the difference between a private lender and New Jersey class? And that question kind of applies to any state agency or many of the state agencies that people might be seeing. So maybe if you can start with what are these state agencies and the loans that people might see and who they apply to?
Yeah, great question. So there's this third bucket of lenders. So that's you have your federal student loans, you have private lenders, which are generally banks and credit unions, and then you have some state-based lenders. So there's a couple of these state-based lenders. They're typically nonprofit organizations that are affiliated with a state. New Jersey Class is one, Brazos based out of Texas is one, MIFA in Massachusetts is one. And what's important about these is that they tend to have extremely low rates because they are nonprofits. They don't actually have to make any money on these loans. Some state-based lenders will have more strict eligibility criteria than others. And so it's a little bit, it will depend on each one. MIFA, the one based out of Massachusetts, actually is available to any US citizen attending any not-for-profit college in the United States. Whereas another company called Brazos only lends to either a Texas resident going out of state or somebody else going to school in Texas.
Chris, just jumping in to understand that, because thank you so much. That was a great question too. So there are these state agencies that will loan people money, and they will loan it even if your person you don't live in that state or the child is not going to school in that state. Are these?
Yes, for some of them, yeah.
Very interesting.
Yeah.
Well, it depends state agency by state agency. So you have to check those requirements.
Yeah.
Yeah, that's very interesting to me. Thank you.
Yeah. If anybody on this call is a Texas resident, which just means you have to have a Texas ID, or if your student is a resident of any state and simply attending college in Texas, we set up a relationship with a company called Brazos, Brazos, that offers by far and away the lowest rates that we've seen in the market right now. So they're a Texas-based nonprofit that is affiliated with the state. And they're currently offering rates from 2.77% fixed to 6.9% fixed. And so if you do fall into that bucket, then I would highly recommend checking them out. And you can use a special link that we have on joinjuno.com to access Brazos and get some additional benefits on top of that.
And Chris, does Juno, because I'm looking for the general, whatever you call these state things, does Juno have a link to these things that we can explore so we can check out? Like my daughter's not going to Texas. My son might at some point,
yeah.
But I think I'm looking now for the source of these state sponsored low interest rate loans, because to me that sounds like a better option for my family than maybe a private. A Jersey, I live in Jersey, so that this is the first one I'll check out. But I would like to know what they call these things, or if there's a link from uh from you know this particular from Debbie's thing or from your thing.
Yeah.
Yeah.
So we have links to the Texas-based one, not to the other ones, but I'd be happy to pull one together and email it to you, or have somebody in my team do that. If you wanted to just email us asking that question at hello@joinjuno.com, which I can just type into the chat box. The one thing I'll actually add to this is to say, right now, I've looked at pretty much all the lenders' sites every week. MIFA, the Massachusetts Educational Finance Authority, has probably the lowest rates that are the most broadly available to people going to different parts, going to schools in different states. And if you get a loan quote from MIFA, then we've actually set up this pretty cool process where Juno works with a private lender. We have a partner who won our business for this year, so to speak. And we've set up this rate match process where if you get a quote from MIFA, whatever it is, we have a really simple process where you can contact us and we can match whatever that lower rate is, and give you 3% of your loan amount as kind of like a cash bonus for going through this rate match process. And so in general, my recommendation would be shop around anywhere that you can possibly find. And at the end of that process, if you do go to joinjuno.com and check out what rate you might be eligible for through our partner lender, if you found a lower rate from almost any other lender, we have this really simple process where we can match that lower rate, or at least we get our partner to match that lower rate. And then we pay you on top of that just for going through that rate match process.
Right, Chris. So what you're saying is do our due diligence, shop around, then go to Juno and check out like, hey, can you match this?
Yeah.
Okay, great. And just to get a little bit more on Juno, then are you whose liability for the loan is it again a co-sign with the parent, or how does that work? Because I think it's fantastic that you're grouping, you're getting lots of loans together, but there's just, is there how our credit ratings are and things like that must factor in at some point, right?
Yeah. So you'd individually be applying to the lender. And so there's two ways to answer this. One, the vast majority of these loans will be co-signed. It's in the name of the student and the parent. And so you end up applying together, and it's pretty, the instructions on how to do so are pretty clear, not just on Juno, but on every private lender's website. But in this process that we've set up, you don't share responsibility for that loan with somebody else in the group. You don't share any risk with somebody else or burden with somebody else in the group.
Good to know. Good to know.
Individually by yourself. Yeah.
Okay. There's a good question, basic question about why are some federal loans subsidized and some unsubsidized?
So when you've submitted your financial aid application and FAFSA, when you get back your financial aid award letter, it will say that you're eligible for federal direct loans. And remember, that's the loan we've been talking about that's in the name of the student and lets you borrow $5,500 for freshman year, $6,500 for sophomore, and $7,500 for the third and fourth. That loan, let's say the financial aid office determines that your family has, let's say, a high financial need, might say that it is subsidized, or some portion of it might be subsidized. If it says that, what it means is that while your student is in school, the government is paying off the interest so that the amount that they owe when they graduate is the same as the amount that they borrow on day one. If it's unsubsidized, which the vast majority of loans are, then it's going to accrue that 5.5% rate each year until the student graduates, and it will continue accruing that until you pay it off.
I've
Uh,
also heard about deferred loans that you don't have to start paying until 6 months after graduation. What's the benefit or not or
Mhm.
doing that or not doing that?
So all federal student loans can be deferred until 6 months after graduation, both the federal direct and Parent Plus. And when you look at different private student loans, you typically have an option where you can select if you want to defer making any payments until all the way up to 9 months after graduation, or if you want to start making payments earlier. I'd say the way that I tend to think about it is that, or the strategies that I hear people use in phone calls are, some people want to just completely defer making any payments until after graduation, and that's fine. There's a lot of other folks who also want to try making some payments while the student is in school to see if they can at least perhaps pay off the interest so that the amount that's owed after graduation isn't too much larger than the amount where you started. What's important to just remember about all of this is there's no prepayment penalty when it comes to federal student loans or almost all private student loans. So if you select a private loan and you say you want to defer making payments until after graduation, or if your federal student loans don't require payments until 6 months after graduation, you can still make some payments early if you are able to and want to keep the interest accrual down without any penalty.
There's a question about and I'm going to combine two questions. A question about, is the Parent Plus loan per year, or do you take it out once for 4 years? And that's a similar question to somebody asking about a lender who is offering a multi-year loan.
So I'm happy to answer the first one, and then Debbie, I know you've got a pretty good answer for the second one, so I'll let you take that. So whenever you're applying for a loan, whether it's federal or private, you should be taking it out for 1 year at a time. And there's really two reasons for that. Reason one is that you're only allowed to borrow up to that cost of attendance number for each given year. So when you're going through the loan process, whether it's federal or private, the lender has to check with the school and make sure that the amount that you're asking for is less than or equal to the cost of attendance for 1 year. So already you actually can't borrow more than that number. Some people then fall into a bucket of saying, hey, I don't actually need the full amount. I need maybe $10,000 a year. Should I borrow $40,000 today, or should I borrow $10,000 each year in 4 separate loans? And my recommendation would be that it's better to do it as 4 separate loans, 1 each year, because you start accruing interest on the amount that you borrow once the money is sent to the school. So if you borrowed $40,000 up front, you'll be paying interest on that for all 4 years. Whereas if you borrowed $10,000 each year, you wouldn't start accruing interest on the, let's say, last $10,000 until 3 years from now. And so it's in your interest to just delay how long you're accruing interest for.
And the question that somebody was asking about, it's a private lender who is offering what they are calling a multi-year loan. And actually, I think there might even be 2 lenders out there this year that's offering it. I just want people to understand what that really means, is that they may be looking at your, income debt to income ratio or your assets, and kind of saying it's likely that we will be able to lend you and all the money that you'll need for 4 years, but it's still technically separate loans that they are giving you each year, because they cannot promise you an interest rate in year 1 that they will then renew every year. So and I think the other slight difference is that in the subsequent years, they may be doing a soft credit pull instead of a hard credit pull every year. But I just want you to know that it's technically going to still be 4 loans, because they need to readjust the interest rate each one of those years, and you need to decide how much you want to borrow each one of those years. So you can take out the loan this year, and even under the umbrella of it being a multi-year loan, and you can still decide next year whether you want to continue with that lender or not. It's just a little bit, there's a little advantage, and it's a lot of marketing. So just want to make it clear.
Those are great answers for me, guys. I really appreciate it. The knowledge you have is helping me already.
Good, glad. There was a question about, do parents have to sign for the Parent Plus loan? My husband is at retirement age. If he took the loan, would he be the only one responsible for the parent loan? What happens if he passes away and I, as the wife, have to be responsible to pay for the loan?
This is a really good question. And so I'm going to actually just put in the chat right now a link, because I was just looking this question up from the Department of Education. And in that it says that your Parent Plus loan will be discharged if the parent dies or if the student on behalf of whom the loan was taken passes. And so, yeah, Parent Plus loans do get discharged.
Yeah, and not to, this is a sad comment, but this we've worked with families with this. If there is an older parent who might have an illness, it is quite honestly beneficial that they are the ones that take out the Parent Plus loan if they unfortunately may not be around as long as the other parent. So it is something to think about, considering what might be going on in your family.
Again, guys, the Parent Plus means the parent is on the hook. That's not, the student gets nothing. They get no credit from that and anything. Okay, great.
Yeah.
The one thing I'll add to that is you should, if you're looking at different private student lenders, it's also important to check what their death and disability release policy is. Right now, most large private student lenders do the same thing that the federal government does, where if the borrower or the co-signer passes, there are different versions of discharge policies that they have. So the loan can get wiped clean, but it's going to vary from one to the other, and you just want to make sure you double check that. It'll either be on the FAQ section of each private student lender's website, or it might be something that you might need to just write in and ask about.
So Chris, there's a question about Juno. It says, I applied for the Juno preferred loan through Earnest. Should I apply for the other option on Juno, the batch of other loan options, since they might have, the question is, will they have a better interest rate?
So if you're on Juno, the way that I would think about it is this. Do your rate shopping at other places. If you want to check your rate at, I'd say there's a website called credible.com where you can check your rates at 7 different lenders at the same time without doing a hard pull on your credit. See what you might be eligible for as step one. If you have and then after that, check what rate you might get on. So when you join Juno, you'll see a button that lets you apply to a company called Earnest. Earnest is the company that we're processing those rate matches through, and the one where we're able to provide people with that cash bonus. I would say do your rate shopping elsewhere, see whatever the lowest rate is you're eligible for, and then check your rate on Juno through Earnest. If you found a lower rate from somewhere else than what you're able to get through Earnest, then there's a pretty simple set of instructions that we have on the website where you just email into us. We make sure that you're comparing similar loans, so a 10-year loan to a 10-year loan, and then we get Earnest to match it on the back end. But I would say like a great place to start rate shopping is that credible.com experience, because it will impact your credit.
Yeah, how does that work, Chris? Because this, I talked to Fannie Mae, and they were like, well, you can, your credit is not dinged when you have multiple, you're checking multiple places for rates. But that's to me, that's a really great thing, because I'd like to know without having a hard credit pull, but I don't quite understand how they do that. Does it impact your credit rating at all to do it at this credible.com?
So good point. So they do a soft credit check. So when they do a soft credit check, it gets a shortened, summarized version of your credit report that typically is very close to identical to your full credit report, but isn't exactly your full credit report. And so at this point, most online lenders will do a soft credit pull so that you can get some sample set of what you might be eligible for. In order to lock those rates in, you still have to do a hard credit check at the end of the process.
No
And so-
problem. But like, does Experian and the credit agency see the soft credit pull?
They don't see the soft
Yeah.
credit pull.
Okay, that's really great.
I think technically, and I've dabbled a little bit in credit world, but but I think what's happening is because the lender is not making you a and there's a term what's leaving my head, but like an official offer of interest, and they're not, they're just giving you a range. That's why they can do it as a soft pull as opposed to a hard pull.
That's great. Thank you, guys. I've been avoiding trying to get a rate because I don't want the credit pull because I don't want to have to deal with all that. But this sounds like a great alternative for me.
Yeah. And one other thing to keep in mind here is that when you do, you will eventually have to do a hard check on your credit. But once you do, Experian's website already says that if you do multiple hard credit checks for the same category of loans, it's not going to impact your credit more than the first hard credit check, as long as you do it in a short period of time.
That's what I've got as well, but I didn't know what that period of time is, Chris. Do you know the period of time? Because I don't want to be scrambling around like in a 1 day period of time.
Not a 1 day period of time, and it's not explicitly laid out, but I think in the article that I was mentioning, it says like a 2 to 4 week window.
Okay.
And I'm pretty sure that TransUnion and Equifax treat it in a similar way, although it's not as explicitly spelled out on their sites.
And from your experience, do you guys, for the soft credit pull, is it pretty reliable as what you will get when they do the hard credit? You're not surprised, right? They don't give you a loss leader type thing. Oh, well, yeah, your soft credit, we could give you 2%. Then you do the hard credit pull, they go, no, it's 6% for you.
Yeah.
I mean,
Great question. The vast majority of the time it's the same exact rate. We did a bit of a sampling with a few of our members, and it was something like well over 90% of the time. What you see in the soft check is what you end up getting after you do the hard check. The only time there's a difference is if there's something meaningful in your full credit report that just isn't showing up on your soft credit check. And I don't have an exact answer to what those things could be or what they most frequently are. But over 90% of the time, there's not really a major difference. And so the rate you end up seeing between those two is the same.
Fantastic. And I just have one more question on the credit. My daughter does have credit. She's had a credit card now and she's paid it off and she has some credit. Is there any way to leverage that credit? Which it's fair right now. We could probably get it up to good really quickly, but is that helpful at all? Or is that just like nothing right now?
For private loans that are where you're going to also be a co-signer, almost all of the pricing is going to be driven by your credit and income, not the student. Because even if they do have credit at this point, the length of their credit history is so short compared to yours that it doesn't influence the rate that gets shown as much. And they don't earn any income while they're in school. So it's not a big influence factor on the rate.
It may help getting you off as the co-signer at some point, right? From what I've read, if as soon as the child has the credit and has a job and things like that, some of the private loans may remove you as the co-signer. Is that your guys' experience or no?
Yeah, so it's an interesting point. There's two ways to answer this. So a common question that we'll hear is, I'm doing a co-sign loan with my student for their college loans. At what point am I no longer responsible for helping to pay this back? And there's two avenues you can take. One is called co-signer release, and each lender does this differently. But some lenders will automatically release you as a co-signer after a certain number of on-time payments have been made. Some other lenders will just have simply different requirements. So it's something you'd have to check on a one-on-one basis. The other path that you can take is once your student has graduated and they have a full-time job, and ideally their credit should be above 700, then they'd be able to do what's called student loan refinancing, which is just like refinancing a mortgage, except there's no prepayment penalty, and it's candidly a simpler process. And all that means is there's other lenders after they graduate who will say, hey, now that you've graduated and now that you have income, you are less risky to lend to. And so I can give you a new loan that's going to pay off all the student loans you had before. You'll have one payment now instead. And depending on what the interest rate environment is like at that point in time, hopefully it's also at a lower rate than what they were paying on all of the other loans before. And so when you refinance that loan, those other loans cease to exist and you're no longer a co-signer.
That is great information again, you guys. It's so nice to talk to experts.
Thanks.
Chris, there's a question about grandparents and what loans that can they or can they not take out?
So grandparents, unfortunately, are not allowed to take out Parent Plus loans. Parent Plus loans have to be the explicit parent of the student. And so grandparents can, though, co-sign on behalf of the student for a private student loan. And so that is something that we'll somewhat frequently see, where one grandparent, maybe to back up for 1 second. So that is grandparents' primary option for how to help on student loans. But in fact, anybody can be a co-signer on someone's student loan. It does not have to be a blood relative or a legal relative of the student in order to co-sign for it. It can actually be anybody.
Chris, there's a general question about what we're discussing today. Does it relate to, or what pieces of what we're discussing relate to graduate loans?
So graduate loans are a little bit different than undergrad, and here's primarily how. So for graduate students, you will have 2 federal student loan options. The first option for grad students typically lets them borrow $20,500 a year at a cost of 7.05%. And you just basically have to fill out FAFSA in order to be eligible for this. Now, if you need more than $20,500 for grad school, then there's another program the federal government has set up called Grad Plus. Grad Plus is really similar to Parent Plus. It's priced the same, you pay it off the same way. And so if you need more than $20,500, then your option through the federal government for a grad loan is an 8.05% rate plus a 4% origination fee. So it actually gets really expensive. So grad students tend to use private student loans after they borrow the initial $20,000 from the government if they need more money at a higher rate than anybody else does. Because it's pretty likely at that point, if you've already been working and you have some credit history, that you'll qualify for a lower private student loan rate than that Grad Plus number, which is again 8.05% plus 4% fee.
So there's a great question. Chris and I talk about this all the time, but we've never had anybody directly ask. But there's a question about who is Sallie Mae and how are they relative, like who are they relative to everybody who we're talking about?
Really, really good question. And so Sallie Mae is the largest private student lender. And they used to be basically affiliated with the federal government. And so still today, a really large percentage of people think that Sallie Mae is a government loan or a federal loan when it's not. It's actually a private student loan, which is something you just need to take into consideration. And so none of the federal loan programs that we've been discussing for the last half hour have anything to do with Sallie Mae.
I think it's the name has just become, and I'm not saying that they are a bad lender, but they are not affiliated with the government. It's just that over time, people have kept that like affiliation in their mind, that because at one point they were a quasi-government agency and they no longer are. And I think the other confusion is because their name is similar to Fannie Mae, which still is, part of the government.
Yeah.
A question about, are Parent Plus loans the only loans that offer income-based repayments?
The federal direct loan, it also offers income-based repayment and income contingent repayment. So remember, that's the one that, so maybe if I back up for a second, some of the rules around the repayment plans for federal student loans are changing right now. And they'll be potentially a little bit more beneficial roughly a year from now, once some rulemaking and policy changes go in place. In general, there's different types of income-based repayment that you can use for lots of different federal student loan programs. And so the federal direct loan that we talked about at the beginning, the one that has a low borrowing cap but has low rates and is available to the student directly, that has a lot of repayment protections. And so you only have to pay a very small percentage of your income if you can't afford to make payments on that one. And then a Parent Plus loan can also have an income-based repayment option, but there's fewer options compared to the one we just talked about. And then again, the graduate student loans also have a lot of income-based repayment options that are similar to what we talked about for the federal direct loan. So in short, they've all got some flavor of it. The federal direct loan, which is the first one we talked about, has the most generous possible form of it.
And Chris, the federal direct actually is applied to the student, right? Yeah, okay. So it's really the student building credit or whatever, or taking that loan. Parent has nothing to do with it. So that's great. Perfect.
So I have to admit, I'm not as familiar with this, Chris, and I don't know if you are, related to students with visas, or in this question, it says H1 dependent kids with an H4 visa, are they eligible to apply for loans?
I don't know the answer off the top of my head, but I'm simultaneously sending an email to somebody on my team who is an expert on this stuff. And hopefully I get a response back in the next few minutes.
Okay. Let's see what else we haven't covered.
Quick question on the Biden repayment student loan. That's applied to the direct federal direct loan, right? And that's the thing that was up in the air about loan forgiveness.
I'm not sure I fully got the question.
Yeah, the politically right now, I think the president is trying to have some student loans forgiven.
Yeah.
And I just wanted to say, is that in my head, that's the direct federal loan that would be forgiven. If like my daughter took 5,000 last year, if that gets forgiven, then I guess that 5,000 is forgiven. I'm just trying to figure that out.
Yeah. And so the way that at least the last attempt to forgive student loans is structured was that it would impact those federal direct loans and grad plus loans and some parent plus loans. And so it was pretty holistic in that you had to qualify or be eligible based on your current income. But as long as you were below certain numbers, then you could have that $10,000 forgiven regardless of what type of federal student loan you had.
Thanks.
To be the primary borrower, does the student need to be 18? My freshman will be 17 until August.
Fantastic question. So for federal student loans, no, you don't have to be 18 in order to borrow through it. For most private lenders, you have to be the legal age of consent in the state that you're borrowing from. And so for most private lenders and for most people, they do have to be at least 18 in order to be a primary borrower on a private student loan.
So there's a few different questions people are asking about the states that they're in. How do you get the state loan? We don't have yet a comprehensive list of every state and if they even offer a state loan. Not every state does. So we just mentioned the kind of the biggest agencies that we know of, which is, Brazos for Texas, MIFA, who will be available for anybody, regardless of where you live. New Jersey has, a state loan. Pennsylvania has a state loan. Rhode Island has a state loan. Those are just like the quick ones off the top of my head. But I would Google your name of your state and, plus, state student loans and see if there's a state agency.
And I'll just throw this in the chat right now. I just spot checked this list, and it does include all of the state-based lenders that I know of. So just make sure you hit show all when you scroll halfway down this page, and you'll see all of them.
Chris, that's the link that you just put there, Nerd Wallet. Yeah. Okay.
Yeah.
That's great. And guys, do you recommend they all ask us, hey, try to get your rate. Do you recommend that we do that? Is that soft as well? Or do you know?
For some of them, it's a soft check. For some of them, they have slightly older tech platforms and they force you to do a hard check. So a couple of those state-based lenders, and frankly, the ones that tend to have better rates, are already on that website I mentioned earlier, credible.com. So if you check that one, you're already going to get soft check rates for a couple of those state-based agencies. The one
That's great. That's great. The one you guys mentioned, the Massachusetts and hopefully Jersey's on there. So that's where I'll go first. Thanks, guys.
And that Massachusetts one tends to be the one that I'd say it's probably the most widely used of those state agencies, just because it is available to anybody from any state, and the rates are also extremely competitive.
That's fantastic.
Which one is that you said is for any state?
MIFA. I'll type it in right here again.
So Chris, if I could go back real quick to the under 18 and inability to get a student loan, that would leave parent loans as maybe the only option for the freshman year. Do the Juno partners offer quotes on parent loans? Because when I went through there, it looked like all I was getting was a quote on student loans.
When you say parent loans, you mean private parent loans, right?
Correct, private parent loans.
Right, we do. And so if you've made an account as a parent, not as a student, and you go through, there should be a screen where you select if you want a student loan or a parent loan. You just to make sure that you're clicking on parent loan. Just want to make sure that you do see that. If not, I'll make sure that we just update the view that you're seeing.
Chris, to make an account on Juno, do you recommend making it as a student account or a parent account?
It doesn't really matter, to be totally honest, because you'll get the same information that's typically tied to what school the person is attending and what their graduation year is. And so you can do either, but as long in the flow, you'll have an option to select student loan or parent loan. And you just want to make sure that you're clicking on one or the other. Now, if you end up clicking on student loan, regardless of what you click on, you eventually have to submit a full application to our partner lender anyway. And in that, you can still change your option if you wanted to see what a parent loan might look like versus what a student loan with a cosigner might look like instead. And so if you have any issues at all with any of that, my recommendation would be if you just message us at hello@joinjuno.com, which I'm adding right here in the chat box. We got people basically 24/7 right now who'd be able to either send you the exact link that you need, or would be happy to hop on a call or a Zoom and walk you through exactly how to get through the flow as well.
So there's a good question. Is it better to take the Parent Plus loan or roll the amount into a private loan if you get the same rate? So if your Parent Plus loan is going to be the same rate as a private loan, is there a benefit to do one versus the other?
It's a great question. And I'd say the only reason why you would consider a private loan in that scenario would be if you really wanted to make sure that there's shared legal responsibility for paying back the loan, or you really care about this loan showing up on your child's credit so that it builds credit for them if you're confident that you're going to be able to pay this thing off. Otherwise, if those two things aren't important, your decision-making criteria, then you're not getting a benefit out of using the private loan versus using the Parent Plus loan. And so I would probably use the Parent Plus loan.
Yeah, just one quick question on, like, when you're talking the vernacular, student loan is really a student and a parent cosigner, while parent loan, if we talk that way, it's only going to be, it's all on the parent. Yeah, okay, great, guys, thank you.
Thank you.
Yeah, so Chris, I'm on Juno's website here, and it just gives me two options: student loans or student loan refinancing. I don't see a parent option in here.
Yeah, you're okay. Let me update that. It's partly tied to the questions that were being answered before, but we will get that updated now.
And I have a question too about loans. So my daughter is currently going to be an in-state student, but her father and I are looking to move out of state at some point. Should we put the loan in her name so she stays an in-state student? Or does it matter?
So in-state tuition is, the way that different states treat it is a little bit different. Where the loan is doesn't really have anything to do with whether you're going to qualify for in-state or not. It's really going to be about where they've established residency is defined by that state. And so, and I think there's a couple of scenarios where each state does this differently, but some will allow you to be out of state for the first year. And then after you've actually been a resident for more than X months with an address, then they'll allow you to qualify for in-state tuition in subsequent years. Some states won't allow you to do that, but it's not at all tied to, let's say, like the loan or where that application is from.
I would just honestly talk to the school and really make sure you understand what their state residency requirements are. Just so you know what might happen if you move out of state and if she stays in state.
Did you guys talk about the origination fee? Because I think, Karen, I didn't hear anything. I may have been writing something down.
No, we didn't. And actually, there's a really good question that somebody said that they heard from other seminars to stay away from the Parent Plus fee. So a Parent Plus loan. We actually didn't explicitly talk about the fees related to the Parent Plus loan.
So the Parent Plus loan fees are, so just to break it down for federal loans in general, all federal loans have an origination fee. That federal direct loan has a small fee at 1%. A Parent Plus loan has a pretty big fee at 4.23%. And the way that fee works is as follows. It's not a cash payment that you make when you take out the loan. It just increases the amount that you have to borrow. And so if you had to pay, let's say $100 to the school in the fall, you'd actually have to borrow $104.23 in order for the school to receive $100. And so that origination fee just increases the principal amount that you owe once you take out that one.
And Chris, you said 1% on the federal direct, right? 1% origination fee on the federal direct?
Yeah, so the federal direct 1.06 roughly.
1.06, thank you.
And for the Parent Plus loan and for Grad Plus loans, it's 4.23.
And so that's a really good question, because for everybody is kind of considering that fork in the road about should you do a Parent Plus loan or should you do a private student loan, along with everything else we've talked about, like who's really responsible for those loans. It is making sure that you're comparing an apples to apples on the interest rate. And Chris, you had a good slide. That's why I emailed you the other day that I wanted to get that slide. We'll post on social media in the Facebook group, kind of what the effective interest rate is when you factor in the origination fee. So if the current Parent Plus loan is something like whatever, 8.0 something percent, if you add in that origination fee, it actually makes the effective rate higher. So, you know, I don't know it offhand, but so I just want to make sure when you're getting quotes from, okay, yes, here it is. When you're getting quotes from Parent Plus loans, that you're comparing apples to apples, the right parent. When you're getting quotes from private loans, sorry, you're comparing apples to apples, the correct interest rate to the Parent Plus loan.
Yeah, so I guess in some of the messages that Debbie's mentioning, we'll also include a link to a calculator that helps you compare the cost of a Parent Plus loan to any private student loan on an apples to apples basis. And so there'll be some basic things you have to fill out, and then it'll help you see exactly what the difference is in costs between option A and option B. And the one thing you want to keep in mind is when you're doing, when you're checking your rates with private lenders, whether it's a soft check or a hard check, you're typically getting back an APR. And you have to convert the Parent Plus cost to an APR in order to compare them fairly. And what that really means is you just have to account for that 4% origination fee in the total cost of Parent Plus. And so all this table really does is say, all right, depending on how many years of school are left, what is the true cost of a Parent Plus loan? And so if this is freshman year and there are 4 years left, the way to think about it is that the Parent Plus loan really costs 8.16% under a standard repayment cycle. If it's the last year of school, then it's actually a little bit more expensive because you're paying that 4% origination fee up front, and there is less time to spread it over between now and when you actually have to pay off the loan. And so when you go through that tool, you just select how many years of school are left, and it makes sure that you're comparing against the right number.
So I wanted to clear up, I got a message that somebody's asking about if the cosigner on a loan passes away, that the loan is discharged. This is for private loans. So for a Parent Plus loan, that is the case. For a private loan, I would honestly say to really double check with each private lender. It might vary. There are lenders who, if the cosigner passes away, that they immediately they call the loan, that it does have to be repaid, or it has to be, you have to find another cosigner. So I don't think it works like completely the same for a Parent Plus loan versus the private loan. That's why sometimes, oh, and also in the case of the student, and maybe that's what I'm thinking. I don't know, Chris, in the case of if the student, God forbid, passes away, the loan is still needs to be repaid for a private lender. So that's why in cases, if you're taking out private loans, it's also recommended to get life insurance for your student.
What I will say is just some of the criteria with our main partner lender, Earnest, the one that we're running that rate match process through. On co-signed loans, if the student who's the primary borrower passes or has a permanent disability, then the loan is fully discharged. If the co-signer passes on most private loans, then the primary borrower still does have that loan in place.
So that works slightly differently than if it's a Parent Plus loan and that parent who passes away, or then the loan is discharged. But so it is slightly different with a private loan.
Yeah.
And how about kind of maybe the last question we'll talk a little bit about is there's a question about how long does it take for money to be dispersed? So maybe, Chris, you want to talk a little bit about like when somebody applies for a loan, they accept it, kind of what's the process that happens after that, about how the money gets to the school, how long does that take?
Yeah, so let's maybe talk about the overall application process in 30 seconds. So the date to work back from, the date to know, is called the tuition due date. each school's financial aid office has a day by which tuition has to be paid in order to be able to enroll in school. And you have to work backwards from that to figure out how long you have in order to apply for a private loan or a federal loan. In general, I'd say you want to be 30 days before that date in order to be safe. Most tuition due dates are at the end of August or the beginning of September. And so you really want to make sure that you've gotten started on your loan applications really in the next 1 to 2 weeks to meet the widest possible number of tuition due dates. When you apply for a loan, that's step one. And that means applying actually means consenting to a hard credit check. And that's kind of how it works for all lenders. Typically, within 1 to 2 business days, you'll find out if you've been approved for that loan. If you've been approved, then you'll get an email from the lender saying, log into this dashboard and see what you've been approved for. And the next step of that process is that for 30 days, the rates that you're approved for are locked. So you apply roughly like within 2 days, you're going to get rates, and those rates are good for 30 days. During that 30-day window, you choose whether you want to sign that loan. Signing that loan basically just tells the lender, hey, I actually want this version of the loan. I want this specific rate and this payment term. And once you do that, what the lender does is they contact the school and they ask, is this person actually an incoming student? Is the amount that they want to borrow less than or equal to the cost of attendance? That is the part of the process that is the least predictable, because some schools might take longer to do it than others. Some schools might be able to do it the same exact day. But as long as you've gotten to that stage, you're pretty safe because you've now signed a loan. It's just moved on to the stage where the school has to verify that you're an actual person attending, and you're pretty good. What happens afterwards is there isn't really anything else that you need to do. The school, once they verify that you're a student, on the tuition due date, tells the lender, hey, I need you to send me the money for this person. The lender sends the money for you. And if you borrowed more than the mandatory tuition and fees, if you borrowed more for living expenses, that additional amount sits in an account that the school opens. And then you log into a portal on the school's financial aid website where you can see that additional amount that you borrowed.
Your student logs in.
Your student has to log in, true. And then they can transfer that money to a personal checking or savings account to use for those living expenses.
Interesting.
Okay, well, I hope that this was helpful.
It was, and I'd like to know, how do we help you guys? Because I feel like this service was fantastic, and I would like to help you guys. So how do we help you?
So the best way to help, I'll tell you, is what I was just going to say is this was really, kind of I don't want to say last minute, but like off the cuff that we decided to do this. So we didn't ask people to register. We will send an email, maybe like summarizing some of this, summarizing the links that you can use and the resources. So if you can help us open the email, read it, and then, go to the resources we recommend. We truly are recommending them because they should be beneficial to you, your student, in finding the best rates. And, quite honestly, if you use these links, it does help us a little bit at the end.
Great.
Thank you very much for the engagement, by the way. Fantastic questions. Really appreciate the back and forth. Makes this really fun and engaging.
Chris, Debbie, you guys, you have helped me so much. It's come down to the last minute. I think my daughter's like on August 20th. So now I know I got to get moving. But this is exactly what I needed, because it helps me with the fork in the road, guys. So much appreciated.
Good. Yeah, I know that these coming weeks are like, these are the weeks you got to get it done. The tuition bills, most of them have been sent. Your students gotta, getting ready. They're going off in August. So we know that there are a lot of questions, and if things come up, you can continue to email me, Debbie@Rhodes-College.com, or Chris is it hello at Join Juno?
Yes. Yeah. Hello@joinjuno.com.
Okay, thanks, everyone.
Thanks a lot, guys.
Thank you
Good
very
luck to
much.
everybody.
you.
Hope everybody's students get, have fun.
We agree. Thanks.
Get the money. Thank you.
Bye.
Bye.